Hello students, this is CA Prabodh Nayak here, and I am a CA, qualified CA. Also after that I have gone on to do my MBA Finance, CFA, US CMA, US CPA and also postgraduate diploma in Treasury and Forex Management. I have been in this teaching line for the last 20 years plus, and I have got a wide range of experience in teaching different types of students in different parts of India, right from the north Delhi, Noida, Bihar, Patna, Surat, Rajkot, and down south also in Chennai, Goa, and Karnataka and Hyderabad also. Basically, I am born and brought up in Bombay. As of now, I am in Bangalore, based in Bangalore, but I teach students all over India for CA Inter, CA Final, CMA Inter, CMA Final. My core topics of teaching are: one is costing, the second is taxation, and the third is financial management. As I'm in this line for the last 20 years plus, I've got a wide range of experience. I've seen a lot of students, I've seen a lot of examinations, and I can pass on my experience to you. And with that, I think you should be taking full advantage of my resources, my talent, and my knowledge. So let us now start with direct tax for CMA Inter. Taxation basically is not a difficult paper, but if you study it systematically, it will be so simple that you will fall in love with tax. Normally students at the beginning, they say that, oh, taxation, so many rules, so many sections and so many calculations. Yes, but once you learn taxation in the right manner, I can assure you that you will enjoy learning tax and also advising your friends on taxation. Yes, so let us make taxation a wonderful subject. And whatever difficulties you are having, you can just go through the syllabus once again, and whatever points you can raise it and we will answer it, right? So let us start with the basic syllabus of taxation for CMA Inter. Now if you see here, the weightage of the topics that you are having, you have heads of income tax, that is basics of Income Tax Act, that is the first part. Basics in the sense, the basic structure of income tax, the Taxation Act, how the Taxation Act is coming to existence, what are the rules and regulations which are surrounding it, what are the different heads of income under which we are having the different incomes which are classified, because each head of income has got a different basis of calculation of tax. And then we have calculation or computation, as we call it, total income and the tax liability. At the same time, we also have to understand what deductions we can get, what benefits we can get from taxation. So if you see, the basics of Income Tax Act carries about 10% weightage in your entire paper. Heads of income, that is a chunk of your syllabus, that carries about 25% weightage, and the remaining 15% is for your calculation or computation of total income and tax liability of individuals and HUF. So that is the breakup of your entire taxation, which is of direct taxation, which is of 50 marks. So weightage accordingly has been distributed. Okay. Coming to the basic syllabus of direct taxation, and we start with the basics of Income Tax Act. The basics of Income Tax Act will be covering the basic concepts, the basis of charge, how do you classify capital and revenue receipts, what is going to be taxed, what is not going to be taxed, residential status and scope of total income, that is, how the taxation is calculated. Taxation is based on the residential status of the individual or the HUF. Then agricultural income, which is actually exempt income, but there are some relations to the calculation of tax also. You get some benefits out of agricultural income. So we have to see how to have the benefits of agricultural income, though it is an exempt income, how to utilize that exempt income to our benefit. And then incomes which do not form part of total income, that is exempt incomes basically. Okay, so that is your first module. The second module is made up of heads of income. Heads of income, dear students, when you are calculating tax, tax is not calculated at a flat rate on all the incomes that you get. You have to classify the income on the basis of what is the income relating to. For example, if you are an employee of a company, then in that case, you will be getting salary income. So, income from salary, that will be taxed separately, right? Then you have your income from house property. You are owning a house, okay? You are owning some property, you are owning some land, you are owning some house properties, which you have given out on rental basis, which you are using for your own purpose, own residential purpose, letting out for residential purpose, letting out for business purpose. So those types of residential house properties and let out properties. Then you have profits and gains from business or profession. Suppose you are not a salaried employee and you are having your own business, or you are having your own profession. Let us say you are a doctor and you are not working at any hospital for a salary. You have your own clinic, you have your own hospital, and you are the owner of that. That is your profession. That is also your business. As chartered accountants or cost accountants, we are also having our own firm sometimes. We are professing as a chartered accountant. We are conducting audits. We are filing income tax returns. As cost accountants, we are rendering our services to different companies. So, we may be having a professional income. This professional income is taxed in a different way. This business income is taxed in a different way as compared to salary income or income from house property. So what are the different deductions that we get over here that we have to see? Then we have capital gains. When a capital asset is sold, we may have a benefit arising from that. So first of all, definition of what is a capital asset, what falls within the purview of the capital asset, right? So those things we have to check. And when we sell those items, the capital gains that we get, the profit that we get, that is taxable at a different rate. Again there, we will have to classify as short-term capital gains, long-term capital gains, because again the rates of taxation will be different for short-term and long-term. And then finally we have income from other sources, which means anything which cannot be a salary income, which cannot be income from house property, which cannot be business or professional income, which cannot be a capital gains, will be classified as income from other sources. Once we calculate the different heads of income under which we are classifying the income, salary income, house property income, business income or professional income, capital gains, other sources, we take the total of all these items and that is called as total income. So total income, which is the total of all the heads of income. Now students, it can so happen that the total income is positive, or it can so happen that the total income is negative. If it is positive, then the tax liability is straightaway calculated. If it is negative, then we can have tax benefits. How do we get the tax benefits? By a process called as set off and carry forward. So a negative income can be set off against a positive income, and to that extent our income tax liability will reduce. So these are the different things that we can have in income tax. Isn't it interesting? Then we have taxation of individual including AMT and excluding non-resident and HUF. Then deductions, rebates and reliefs, deductions under various sections, Section 80 is one of the main deduction section. Okay. Then advance tax paid. Many people pay advance tax during the year. Okay. Quarterly paid. Then filing of income tax returns, getting a PAN number, self-assessment and limitation, and intimation of the tax liability. So these are the things which are covered in module 3. So in this way we are having different modules for direct taxation. I suppose there is total clarity in all the topics that we are going to deal with in the subject of direct taxation, right? Students, let us try to understand why tax is collected by the government. There are many projects which need to be undertaken, which require huge amounts of capital. For example, you require to invest in the infrastructure of the country. Infrastructure, construction of roads, construction of railways, construction of ports, which requires huge amount of capital investment. Then providing medical care, schools, colleges, that is basic education. That is also one of the responsibilities of the government. Providing basic necessities of life to people. These are all welfare activities which are to be conducted. And these welfare activities to be conducted, the government requires a huge amount of capital. How will the government get this capital? The government will get this capital on the basis of taxation, which are of two types. One is called as the direct tax, the other is called as the indirect tax. Basically, what is tax? Let us try to understand that. So, here as per your module, you are given that tax is the compulsory levy by the government on income, commodity, services, activities or transaction, which takes into consideration the direct tax as well as the indirect tax. If you are calculating the tax on income, it is the direct tax. If you are calculating the tax on commodities, on services, on activities, then it is called as the indirect tax, right? The word tax is derived from the Latin word taxo. Taxes are the basic source of revenue for the government. And as I told you, why the government requires revenue? For the purpose of undertaking welfare activities. Providing basic health facilities. We have municipal hospitals in India, right? They are run by the government. So when I say government, it can mean the state government or the central government, right? Now, so municipal hospitals are there, municipality boards are there, you have to maintain the roads clean, whatever garbage is there that has to be taken. So we have to employ people for that. The government has to employ people for that. They have to be paid salary. At the government hospitals, you need doctors, you require nurses, you require ward boys. So they have to be paid as salaries. You require the basic infrastructure in the hospital, an operation theatre. For that you require some capital expenditure. So all these things will require cash, will require capital investment. So this capital investment is going to come from where? It is going to be coming as a source of revenue by collecting the tax. Now tax is not collected from every person. Those who can afford to pay, they will pay tax. Those who have higher levels of income will pay higher tax. Those who have lower levels of income will have lower tax. Those who have income below a particular level will not pay tax. But tax is not compulsory. Direct tax is not compulsory. Yes, indirect tax is compulsory because there you are purchasing goods and on those goods which are purchased, you have the tax and that is levied on all the products. But as far as income is concerned, you will tax more for a person having higher income and the government will tax less for a person having lower income. Okay? Further, few of the income of the person are not subject to income tax. Some people are not liable to pay tax because their income is not falling within the taxable bracket. Those income are exempted income. Income tax in India is governed by what? Main important thing. In India, income tax is governed, regulated, the rules and regulations, the law is in the Income Tax Act of 1961, which came into existence on 1st April 1962. The year, the dates are important. So, Income Tax Act 1961, which came into effect on 1st April 1962. Okay, this act provides for determination of taxable income. What is taxable income? All income is not taxable. So what is taxable income? What is a tax liability? What is the procedure for assessment? What is the procedure if the government sends you a notice saying that this is the amount of tax payable? Are you supposed to pay tax compulsorily? No, you can appeal against it. You can say, no, I feel that this is not correct. And why it is not correct? You can appeal for that. If you don't pay the tax on time, the government can charge you penalties. So penalties are there, prosecutions are there. If you don't file the income tax returns on the due date, if you file it late or if you don't file it, the government has got the right to charge penalties. So from where it is coming? From the Income Tax Act of 1961, right? So what happens and how this is done? The Finance Act shall bring amendment to this act year by year. Since it is the 1961 Act that we are talking about, now we are in 2024. 1961, it was 50-60 years back. So, does the law remain the same? No, it will change with the changes in the circumstances. Now, in 1961, we did not have anything like a debit card, a credit card, an ATM card. ATM was not there. Okay, this so-called plastic money was not there. This so-called UPI payments were not there. GPay. Okay, so as the things change, the law has to change. Now, in the future, maybe when you grow up and you have children, they will learn a new form of currency called as cryptocurrency. So whether it is going to be taxable, whether it is not going to be taxable, how it will be taxable, how it is going to be recorded in the books of accounts, everything again will have to change. So as the circumstances in the financial world change, the act has to be amended. We can't throw the act away. The basic infrastructure of the act will remain the same. But we'll need to make some changes to the act. That is called as amendments to the act. And that is done every year by having a Finance Act. So the Finance Act shall bring amendment to this act year by year. And who presents this? It is presented by the Finance Minister. Who is the present Finance Minister? Nirmala Sitharaman. You have to know. Nirmala Sitharaman is the present Finance Minister. She presents the finance bill in both the Houses of Parliament. Once the bill is passed in the Parliament and gets the assent means sanction of the President of India, it becomes a Finance Act. So first it is presented as a finance bill in both the Houses of Parliament, Lok Sabha and Rajya Sabha. It has to be accepted. The members of Parliament may make some changes in that, may propose some changes. So those changes are made. It is sent to the upper house, Rajya Sabha. It is approved over there. It is sent to the President. President will give consent and then it becomes a part of the act. The administration of direct taxes is with the CBDT. CBDT is Central Board of Direct Taxes. The Income Tax Act 1961 empowers the CBDT to frame the rules from time to time to carry out the purpose and proper administration of the act. Law has been written in 1961 Act. Law has been written. Amendments are made every year by the Finance Act. But implementation has to be done by people now. Now, who are the people who are going to do the implementation? The CBDT, the Central Board of Direct Taxes, under which the Income Tax Department comes. So, they will be setting out the rules and they will be called as Income Tax Rules 1962. Income Tax Act is different, Income Tax Rules are different. So, to carry out the proper administration of the Act, rule framed by CBDT named Income Tax Rules prescribes forms, procedures, principles of valuation which are to be followed while computing the income tax. Okay, These releases clarify the doubts regarding the scope, object and meaning of various provisions of the Act. The circulars are binding on assessing officers but not on the assessee and the courts. We'll see that as we come to it. Now let us come to the basic concepts, basis of charge and how to classify the receipts as capital and revenue. Interesting part. Okay. Let us directly come to this. What is the purpose of government charging tax? In a welfare state, the government takes primary responsibility for the welfare of all its citizens to provide basic infrastructure like roads, railways, ports, water, electricity, right? As in matters of healthcare, education, employment, social security, and other developmental needs. To facilitate these, government requires revenue. And taxation is a primary source of revenue to the government for incurring such public welfare expenses. Okay. Now, what are the basic reasons for imposing tax? Let us come to each of these reasons. The first one, I'll number the reasons here. The first one is to provide basic facilities for every citizen. Water, road, electricity, medical, healthcare facilities, education, primary schools and colleges, educational institutions. Provide basic facilities for every citizen. Whatever money is received by the government from taxation is spent by it for the welfare of the citizens of the country. Okay. Some of the services provided by the government are healthcare, electricity, roads, education system, free houses, which is now being done by the government, for the poor, water supply, police for maintaining law and order, firefighters, judiciary system, okay, disaster relief, taking care of bridges and other things of public welfare. So, in other words, providing basic infrastructure facilities to all the people staying in the country, right? Second point, to finance multiple governments. Now, in India, we are having state government, central government. And in the state, we are having municipal bodies, we are having gram panchayats, we are having local bodies, okay? So, all the local governments of the state like village panchayats, block panchayats, municipal corporations, they receive the funds from the Finance Commission. And from where does the Finance Commission receive the funds? From the public by way of tax. Third one is protection of life. Protection of life and wealth from the government in case of external aggression. If an enemy country attacks, then defense, the defense sector is normally controlled by the government, maintained by the government, the army for example, right? So external aggression, internal armed rebellion, we have the CRPF, we have the CISF, right? Or any other situation, protection of life, protection of property. As I told you that basically there are two types of taxes, direct tax and indirect tax. Why it is called direct tax and why it is called indirect tax? Direct tax means that when the government is charging tax, it is having a direct impact on the individual concerned or the company concerned or the entity concerned. For example, government is charging 20% tax on my income. If I am earning 100 rupees, I will have to pay 20 rupees to the government. So how much will I get in return? I will have only 80 rupees in my pocket. Which means I will feel the pinch, isn't it? Yes, I will feel the pinch. That if I am earning 100 rupees, oh my god, 20 rupees is going to the government. I get only 80 rupees. If I am earning 200 rupees, then 20% of 240 rupees is going to the government. I get only 160 rupees. So I feel the direct impact on my pocket, on my purse. That is direct tax. Indirect tax. So tax of which incidence and impact fall on the same person is known as direct tax. That is income tax. On the other hand, tax of which incidence and impact fall on two different persons is known as indirect tax. GST, for example. GST is levied on all goods. Okay, now it means that as in the case of direct tax, tax is recovered directly from the assessee, who ultimately bears such taxes, whereas in the case of indirect tax, it is recovered from the assessee, who passes such burden to another person and is ultimately borne by consumers of such goods or services. Now, for example, a shopkeeper purchases butter, Amul butter. When he purchases Amul butter, he pays GST to the supplier. He pays a tax, and that is called as goods and service tax, GST. We'll do it in indirect tax. Now, what he will do? He is charged with the GST, but he will recover that GST from his customer who buys that butter from him. Correct? He is not ultimately paying the tax. The final consumer who buys the butter from him is going to pay the tax. So, though the shopkeeper pays GST initially, he will recover it from his customer who buys the product from him. So, there are two persons involved. One is on whom the tax is levied, and the other from whom the tax is collected, is recovered. Right? So, who ultimately bears such taxes, whereas in the case of indirect tax, it is recovered from the assessee, who passes such burden to another person and is ultimately borne by consumers of such goods or services. Okay, so type of taxation, direct and indirect tax. Incidence for direct tax and impact fall on the same person. Here it falls on two different persons. Correct? Second, assessee himself bears such taxes. Since only one person is there, only one person, that means that particular person is going to bear the burden of tax. Himself bears such taxes. But here it is recovered from the assessee and he passes on the burden to another person. Levied on income. This is levied on goods and services, GST, goods and service tax. For the goods purchased, for the services purchased, you are paying tax. Okay? This is progressive in nature. Higher the income, higher the tax. Lower the income, lower the tax. Right? So, it changes and it depends upon the level of income. If your level of income is high, then in that case, your tax is also high. But if your level of income is low, then it is going to be lower. Okay. On one hand, the direct tax is progressive in nature. On the other hand, the indirect tax is regressive in nature. Meaning, it is not like a higher person will pay a higher price. A person who is getting more income will pay a higher price for the butter, and a person who is having less income will pay less price for the butter. Butter cost will remain the same. Whether you are purchasing, you are a student, you don't have income, but you are purchasing it. For you also it will be the same, for me also it will be the same. Right? So it is same for all persons. So it will bear equal rate of tax on goods or services consumed. The axe will fall on all the people in the same manner. Irrespective of whether you are rich or poor, it doesn't matter. The price will be the same. 1 kg of apples will be costing you the same, whether you are a rich person or a poor person. Right? 500 grams of butter will be costing you the same, whether you are a rich person or a poor person. Right? So, it is like that. Constitutional validity of taxes. The Constitution of India is the supreme law of India. That is a basic law which governs all of us Indians. right? That is the basis on which we frame other laws. Does the Constitution allow the government of the country to collect taxes? Let us see. It consists of a preamble, 22 parts containing 444 articles and 12 schedules. Any tax law which is not in conformity with the Constitution is called ultra vires the Constitution, and it will be illegal and void. So you cannot charge tax which is not permitted by the Constitution, right? So what are the provisions of the Constitution which are affecting this? The first one that you are going to have, I'll just mark it, I'll highlight it. Article 265. Article 265 of the Constitution lays down that no tax shall be levied or collected except by the authority of law. Hey, that doesn't mean that any person can go and collect the tax. I cannot say, hey, I am collecting the tax on behalf of the government. No. Are you authorized? You can ask me that. Are you authorized? I say, no, I am not authorized. Then how can I collect tax? So, it can be levied or collected only by the authority of law. It means that the tax proposed to be levied must be within the legislative competence of the legislature imposing the tax. Okay? Now, next one is Article 246, read with Schedule 7. This divides the subject matter of law made by the legislature into 3 categories. This is very important for you. The first one is called as a union list, the second one is called as the state list, and the third one is called as a concurrent list. Union refers to central government. State list means only the state government. Concurrent, combination, state and or central government. Let us see. Union list, only the central government has the power of legislation on subject matters covered in the list. So, in the union list, whatever forms of taxation are given, that can be imposed only by the central government and collected by the central government. State list will contain a list of items which can be taxed by only the state government. Central government has no authority. Concurrent list, either the central government or the state government can pass legislation on certain matters, and either of them can collect the tax. Okay? Now, let us see union list, what all things are there. In the union list, which is called as list 1, in the state list, which is called as list 2, and the concurrent list, which is called as list 3. Union list, that is list 1, is giving you details on taxes on income other than agricultural income. In other words, agricultural income, leaving that besides, whatever other source of income are there, that is charged in the first union list, list number 1. So, who can collect the tax? The central government. Can central government tax agricultural income? No. State list. Taxes on agricultural income. You will say, sir, agricultural income is exempt from tax. Yes, relax. We'll come to it. It is exempt income, but there is a catch over here. That catch we will see when we are doing that particular topic of agricultural income. Okay, so wait, there is climax, there is anti-climax. Now, the next important thing is sources of income tax law in India. The provisions of income tax extend to the whole of India and became effective from 1st April 1962. As I told you, it is the Income Tax Act of 1961, which came into effect on 1st April 1962. Okay, this act contains provisions for determination of taxable income, determination of tax liability, procedure for assessment, appeals, penalties and prosecutions, and powers and duties of income tax authorities. These are the 4 things which are contained in the Income Tax Act 1960. So the Income Tax Act 1961 contains provisions for what? Once again, determination of taxable income, calculation of what is taxable, what is not taxable, taxable income. Second, once you calculate taxable income, what is the tax liability on that income? So tax liability, determination of tax liability. Third step, procedure for assessment of that tax liability. If you feel that it is incorrect, then appeals, procedure for appeals. If the government thinks that you have filed the income tax returns late or some provisions have been violated, government has the authority for penalties and prosecutions. So that procedure is also given in the Income Tax Act 1961. And then powers and duties of income tax authorities. Okay. Now, that is the first part. So, we started with Income Tax Act 1961. Then annual amendments which are there. How do you get annual amendments? Yes, through the annual budgets which are prepared by the finance minister every year. So, annual amendments. Income Tax Act has undergone several amendments from the time it was originally enacted through the union budget. Every year, a finance bill is presented before the parliament by the finance minister. I told you this. The bill contains various amendments which are sought to be made in the areas of direct and indirect taxes levied by the central government. When the finance bill is approved by both the House of Parliament, it goes to the President for assent. And then the President gives the assent for the bill, and then that bill becomes an act. The provisions of such Finance Act and thereafter incorporated in the Income Tax Act. If on the first day of April of the assessment year, the new Finance Act has not been enacted, the provisions in force in the preceding assessment year or the provisions proposed in the finance bill before the parliament, whichever is more beneficial to the assessee, will apply until the new provisions become effective. That means if the debate is going on in the parliament, in the Lok Sabha, in the Rajya Sabha, it has been delayed, you know now. Sometimes opposition creates a ruckus, they stop the proceedings of the parliament. So when that happens, you are not able to pass the bill. And like that entire year goes on. Bill is not enacted, bill is not converted into act. It is not passed by either House of Parliament. Then in that case, whatever are the provisions in the previous bill or whatever provisions are proposed in the present bill, whichever is more favorable to the assessee, to the income tax payer, that will be applicable. Okay. Then we have Income Tax Rules 1962. We started with Income Tax Act 1961. Then we had the amendments in the form of Finance Act. Now we are coming to Income Tax Rules 1962. As per section 295, the board means what? CBDT, Central Board of Direct Taxes, not Board of Directors. Central Board of Direct Taxes may, subject to the control of the central government, make rules for the whole or any part of India for carrying out the purposes of the Act. Implementation of the Act has to be done. So for that we require some rules and regulations. So for those rules and regulations, the CBDT may make some rules subject to the approval of the central government. Such rules are made applicable by notification in the Gazette of India. These rules were first made in 1962 and are known as the Income Tax Rules 1962. Since then, many new rules have been framed or existing rules have been amended from time to time, like the Income Tax Act, and the same has been incorporated. See the order of the events now. Income Tax Act 1961. Amendments to the Income Tax Act 1961 with the help of Finance Bill. Income Tax Rules 1962. The fourth one is Circulars and Clarification by the CBDT. Under section 119, please remember the section numbers. The board may issue certain circulars and clarifications from time to time, which have to be followed and applied by whom? Not by us taxpayers, but by the income tax authorities. It is not for us. It is not for you and me. It is for the department. It is for the department, income tax authorities. Effect of circulars. These circulars or clarifications are binding upon the income tax authorities. They are not binding on the assessee. However, the assessee can claim benefit under such circulars. If the assessee finds that there are some benefits for him, you say, hey, you have got that circular passed by the government, passed by the CBDT, remove that. There is something in it for me also. Show me that circular, or I will show you that circular and say, hey, this is the benefit which is for me. It is not compulsory for us to follow the circulars because it is not a circular meant for us. But if there is a benefit in that, I will point out that there is a benefit in it for me. Please implement that benefit. Right? Next one. Judicial decision. Decision of Supreme Court. Judicial can be Supreme Court, High Court, District Court, Appellate Tribunal. So, decisions given by the Supreme Court. Any decision given by the Supreme Court shall be applicable as law till there is any change in law by the Parliament. Such decision shall be binding on all the courts. Binding on all the courts. Once the Supreme Courts give the decision, then all the courts, all the tribunals, all the income tax authorities and all people like you and me have to follow, because that is a apex court. You can't challenge decision by the Supreme Court. Now, contradiction in the decisions of the Supreme Court. If there is a contradiction, okay, if apparently there is a contradiction in two decisions, one given last year, one given in the current year, the decision of the larger bench, whether earlier or later, shall always prevail. However, where the decisions are given by benches having equal number of judges, the decision of the recent case shall be applicable. So last year there was a 3-judge bench, this year there was a 2-judge bench. The decisions are different. Last year 3-judge bench, that will be more applicable. Last year also there was 3-judge bench, and this year also there is a 3-judge bench. But both of them have given different decisions. Then the recent one, this year's, will be applicable. Decisions given by a High Court or ITAT. Income Tax Appellate Tribunal. ITAT means Income Tax Appellate Tribunal. How is that applicable? They are binding on all the assessees and income tax authorities, but falling under their jurisdiction only unless it is overruled by a higher authority. Example, in Tamil Nadu, the Madras High Court, the High Court in Chennai is called as Madras High Court. The Madras High Court gives a decision that is applicable for the assessee who is in Tamil Nadu. It is not applicable for an assessee who is in Karnataka. It is not applicable for an assessee who is in Delhi. He may refer to it. He will say, okay, there was a similar decision in the Madras High Court. So can we apply that? But it is not automatically applicable. That in Madras High Court they have passed this decision, so the same will be. You can say that in Madras High Court this was the judgment given. Can we apply that to our case? So a reference can be drawn because Madras High Court has given the judgment for people in its jurisdiction. Every court has got a jurisdiction. For Supreme Court, the entire India is jurisdiction. So once Supreme Court gives an order, it is applicable for all India. That means all the high courts, all the district courts, all the income tax authorities, all the assessees. But Income Tax Appellate Tribunal gives a decision only for its particular jurisdiction. High Court gives its decision only for its particular jurisdiction. I suppose that is clear, right? So we have done all these things now. The basics of income tax we have done, the basics of income tax, and now we will have to see further what are the basic principles for charging income tax. That is the next thing that you are having, which is now again section numbers are important for you, section 4.